You might think you've heard the Enron story. But what if we told you there's more to this shocking saga than meets the eye? Enron, a name once in the same lane with energy innovation, played a role in shaping not just an industry, but the entire world of finance. It was a force that impacted the lives of millions, reshaping the way we think about corporations. But beneath the corporate headquarters laid a web of deceit that forever altered the course of financial story. You won't believe what was hidden behind the balance sheets. So stay with us, because the truth about the WorldCom scandal is far more jaw-dropping than you can imagine. $11 billion accounting fraud. WorldCom. WorldCom was a telecommunications company that was established in 1983 after the breakup of AT&T by Murray Waldron, William Rector, and early investor Bernard Ebbers, among others. The group secured a $650,000 loan, which allowed them to buy the technology to route long-distance calls. The company had experienced a good growth throughout much of the 1990s, mainly by achieving a number of highly profitable acquisitions of other telecommunications companies, including MCI Communications, which is a company with 2.5 times larger revenue than WorldCom for $37 billion in 1998. It didn't stop there. It moved aggressively into internet communications, and by 2001, it was handling half of all internet and email traffic in the US. For this new acquisition to be successful, it had to depend on the company's stock price staying on a consistently upward lane. Until early 1999, the process seemed to be making progress for the company, especially for Ebbers, who was worth an estimated $1.4 billion and had been named the 174th richest American on the Forbes 400. But that year saw WorldCom's revenue growth begin to slow, which in turn dragged down its stock price. This could partly be due to the large supply of US telecommunications networks at the time, which increased demand in the face of excessively bullish expectations surrounding the growth of the internet. And to worsen matters, its proposed merger with Sprint Corporation was shut down that year based on antitrust concerns. As such, there was much concern from Ebbers and senior management that WorldCom's earnings would not meet the expectations set by analysts from Wall Street. In response, WorldCom began tampering with its financial statements to conceal its false performance and give the impression that it had met those analysts' projections. It reduced the amount it held in reserve by $2.8 billion and reclassified those funds as revenues. It then did the same with operating expenses that represented the amount WorldCom paid to other telecommunications companies to access their networks, hiding those expenses as long-term capital investments. The whole switch-up gave WorldCom an additional $3.85 billion, the changes making it appear as though the company had generated $1.38 billion in profits, along with heavily inflated assets. Ebbers continued to manage Wall Street expectations of double-digit growth by reporting the manipulated numbers and presenting the false impression of a thriving company to the market, as well as internally to both the WorldCom employees and board of directors. But he was receiving information internally that was wholly inconsistent with such an impression, particularly from CFO Sullivan and WorldCom's controller, David Myers. Indeed, much of the fraudulent activity was conducted under the direction of Sullivan, as the company continued failing to meet financial targets announced by Ebbers. Sullivan continued making false accounting entries to give the appearance that those targets were being achieved. And he was also assisted by Myers, who similarly directed the making of unsupported entries. Evidence also made clear that Ebbers was aware of the manipulations being undertaken by Sullivan and Myers, and Sullivan later confirmed that Ebbers knew of the capitalization of line costs. And yet, the chief executive continued to make unrealistic projections to the market and failed to disclose any of the internal dishonesty taking place. Some believe this was the case because Ebbers was more concerned about protecting his vast personal wealth and his huge salary, which made him one of the country's highest-paid executives. By February 2002, WorldCom's results for the fourth quarter of 2001 were well below Wall Street expectations, and the company reduced its guidance for 2002. But Ebbers still provided a very upbeat outlook for the company, saying, "We have a solid investment-grade debt rating, and we are free cash flow positive. And let me be clear, we stand by our accounting." Ratings agencies subsequently downgraded WorldCom, with a large downgrade putting WorldCom debt at junk status. Furthermore, WorldCom's internal audit committee also undertook a review of the company's capital expenditures, despite opposition from Sullivan and Mayers. More personnel began questioning Sullivan and Mayers about the dubious accounting entries before Mayers finally admitted to internal auditors that he could not support the capitalization of line costs. Once the audit committee was made aware of the irregularities, they duly terminated Sullivan. Nevertheless, Ebbers resigned in April after being told he would be dismissed by the board. Shortly after Ebbers was forced to step down as CEO in April 2002, it was revealed that he borrowed $408 million from Bank of America to cover margin calls in 2000, using his WorldCom shares as collateral. On June 25, 2002, WorldCom disclosed to the U.S. Securities and Exchange Commission, or the SEC, and the public that for 2001 and the first quarter of 2002, it had determined that certain transfers amounting to $3.852 billion from line cost expenses to asset accounts were not made in accordance with Generally Accepted Accounting Principles, or the GAAP. A few weeks later, the company filed for bankruptcy. Shortly before revealing an additional $3.831 billion in improperly reported earnings for 1999, 2000, 2001, and the first quarter of 2002. The next day, the SEC filed a lawsuit against WorldCom shortly before the board of directors accepted a full, independent investigation of the accounting practices that occurred. Hearings were also held by the House Committee on Financial Services and the Senate Committee on Commerce, Science and Transportation. In total, WorldCom made more than $9 billion in erroneous accounting entries to achieve the impression it was making profits. It was created by a few key members of senior management based in the company headquarters in Mississippi and executed by employees in the financial and accounting departments across various locations. The SEC concluded that the scandal was very much the result of the way CEO Ebbers ran WorldCom. He was at the heart of the company's culture and put much of the pressure that led to the fraud lasting as long as it did. A lack of controls within the financial system at the time also played a major contributory role in the fraud. As the SEC reported, the false accounting entries were easily made because it was apparently considered acceptable for the General Accounting Group to make entries of hundreds of millions of dollars with little or no documentation beyond a verbal or an email directive from senior personnel. Several persons played an important role in exposing the fraud at WorldCom. These people included Cynthia Cooper, who was vice president of WorldCom's internal audit department, and Gene Morse, another auditor. Cooper and Morse conducted investigations on their own as well as an audit. They were challenged by the company's chief financial officer, or CFO, Scott Sullivan, who requested that the process be delayed. They contacted KPMG, the external auditor that replaced Arthur Andersen, as well as WorldCom's audit committee. As a result of her diligence, Cooper was named a Person of the Year by Time and was featured on the magazine's cover in 2002. She is now an author, consultant, and internationally recognized speaker. Bernard Ebbers was convicted on 9 accounts of securities fraud and sentenced to 25 years in prison in 2005. He was granted early release from prison on December 18, 2019 for health reasons after serving 14 years of his sentence, but he passed away in 2020. Former CFO Scott Sullivan received a 5-year jail sentence after pleading guilty and testifying against Ebbers. Moreover, WorldCom's former bank settled lawsuits with creditors for $6 billion without admitting liability. Around $5 billion went to the bondholders, with the balance going to former shareholders. In a settlement with the Securities and Exchange Commission or SEC, an MCI was formed, and the newly formed MCI agreed to pay shareholders and bondholders $500 million in cash and $250 million in MCI shares. However, MCI and all of its network assets were acquired by Verizon Communications in January 2006, although it managed to restructure and emerge from bankruptcy. WorldCom's example helped other corporate management teams and investors learn a valuable lesson. If something looks too good to be true, it probably is. We hope this exploration has left you with a sense of awe and perhaps a touch of skepticism about the world of big business. Remember, even the mightiest can fall, and even the darkest secrets can see the light of day. So, stay curious, stay vigilant, and stay tuned on this channel for more exclusive revelations, because in the end, the truth is a journey worth taking. Thank you for being a part of it, and don't forget to subscribe to our channel. See you in the next video.